Can anyone hear me?
Yes, we can hear you.
Good. Now, please help me read the question.
Uh, your screen is blurry. At least for my end, your screen is blurry. I don't know if it's like that for others.
Does anybody have access to WhatsApp groups so you can download from there and read?
Do you have the?
Anyone? Question?
Okay, let me read it.
Good. Thank you.
Our Co is expecting to receive $48 million on 1st February 2024, which will
Okay.
be invested until. Can you hear me?
Yes, I can hear you. Please go ahead.
Okay, our Co is expecting to receive $48 million on 1st February 2024, which will be invested until it is required for a large project on 1st June 2024. Due to uncertainty in the markets, the company is of the opinion that it is likely that interest rates will fluctuate significantly over the coming months, although it is difficult to predict whether they would increase or decrease. Co's treasury team wants to hedge the company against adverse movements in interest rates using either forward rate agreements, interest rate futures, or options on interest rate futures. Co can invest funds at the relevant interbank rate less 20 basis points. The current interbank rate is 4.09%. However, Co is of the opinion that interest rates could increase or decrease by as much as 0.9% over the coming months.
Okay, stop hearing
The
you.
following information and quotes are provided from an appropriate exchange on futures and options. Margin requirements can be ignored. 3 months futures, $2 million contract size. Prices are quoted in basis point at 100 annual percent yield. December 20x3, 94.8. March 20x4, 94.76. June 20x4, 94.69. Options on 3 months futures, $2 million contract size. Option premiums are in annual percent. Should I read out the
Yes,
table or
please.
there's no
No, no,
need?
no. Just skip the table.
I should skip. Okay. So we'll just go to. It can be assumed that settlements for the futures and options contracts is at the end of the month, and that basis diminishes to zero at contract maturity at a constant rate. Based on monthly time intervals, assume that it is 1st November 20x3 now, and that there is no basis risks required. Based on the three hedging choices Co is considering, recommend a hedging strategy for the $48 million investment. If interest rates increase or decrease by 0.9%, support your answer with appropriate calculations and discussion. A member of AWANCO's treasury team has suggested that if option contracts are purchased to hedge against the interest rate movement, then the number of contracts purchased should be determined by a hedge ratio based on the delta value of the option.
But I think no need for that. We'll just focus on only option A and question A, which is where we are solving for today. So before we go ahead, what do you understand by what you just read? Hmm? Are you there? Can you hear me?
Yes, we can
Yes.
hear
So the
you.
question you read, tell me what you understand.
Yes. What we understand is that there's a large sum of money that our code is trying to invest over a period of time until it is needed.
Mm-hmm.
And they are relying on historical data and future projections to make a decision on how it should be invested.
Okay. So good, good. I think that's a fair understanding. First question, were you in my class last week?
No,
Okay.
unfortunately.
Okay. So last week we started from last 2 weeks we started interest rates. We started risk management, treasury risk management. Then we used last week to discuss the theory aspect of treasury risk management. Spoke about all the functions of the treasury units, the types of risks we are faced with, and the risk hedging strategies that are available. So for last week, we looked at currency risk management, which focused on managing exchange rates and how payments and receipts, or let's say expected payments and receipts in foreign currencies can be hedged. So we had a full workup on that. Let me switch to my Excel. We had a full workup on that on a different hedging instrument that can be used, where we have the money market hedge, we have the use of forwards, the use of futures and options. So then we concluded that the most what's the word? The recommended approach would be use of forwards, just because it is slightly more expensive than the futures and comes with a reduced risk as compared to the futures. So today we'll be going forward to what we call interest rate risk management. And what we're trying to hedge here is the risk of increase or decrease in exchange rates. Now, generally speaking, where you have where you are borrowing at floating rates, there is a risk that your rate might rise or fall in recent time. So you might want to you might be interested in hedging that risk to ensure that they don't rise or fall unnecessarily. Meaning that where you are borrowing, you will not like interest rates to rise up because it will mean more cost for you. And where you are investing, you don't want interest rates to fall before you invest because it will mean less return for you. So what this we are trying to do is trying to understand the different instruments to be used for hedging this risk. That's part one. So at any point in time you have any question, please. I think we can. I think we all have the ability to unmute. Yes, so just unmute your mic and call my attention. Then give me a minute so I can finish my statements. Then you ask your question. That way, the class is not dragged further backward because some didn't understand what I said 5 minutes ago and the person did not speak up. So I would always ask questions during the classes. I would try to ensure that my students are following as much as possible. But remember, I'm the one lecturing, I'm the one with the knowledge, and you are the one that needs the knowledge and you have paid for it. So as much as I'm willing to teach, you should also be willing to share your feedback over things that seem unclear to you. Now, that's just simple rules. I like an orderly class. We speak one at a time, try not to interrupt each other, and we will have fun today. This is like my best topic in AFM, and I enjoy taking it. Now, that's by the way. Next point is the fact that for interest rate risk management, there's something we need to understand. You know, for currency risk, the instrument boards are most likely tied to the transaction they are hedging. For example, where you want to make a payment, you have agreed a rate, you most likely exercise that rate, and that rate will be what you will use to buy or sell your home currency or to buy or sell the currency needed for that transaction. So there is no divide between your hedging instruments and the transaction you are trying to conclude. However, for interest rate risk management, there is a difference because your hedging instrument is bought separate from the transaction you are trying to hedge. What do I mean? Your hedging instrument is bought today or the day of decision, which is always coming today, then your transaction is now concluded on the expected day of transaction. So if you want to borrow money from the bank, you buy a hedging instrument today and you wait, then in 3 months or 6 months or 2 months time that you actually want to borrow that money, you go and borrow from the bank. You don't borrow from whoever you got into the hedging agreement with. Does that make sense? Good. So in this case, this information we've provided now would give you understanding as we begin to solve our question. So let's just do basic fact check so we can move on with our question. So our uncle is expecting to receive $48 million. So amount to be received. Amount to be received is $48 million. Good. That's information one. On 1st of February 20x4, which will be invested until one for the last project in 1st of June 20x4. So investment dates is 1st February 24. Okay. Then will be invested until required for a large project in 1st June 20x4. So maturity date 1st June 24 also. Then next information need is investment period. Investment period, we are investing from February to June. So it's actually February to end of May. So it's February, March, April, May. That's 4 months. So we write it here 4 months. So all this information will become relevant as we solve. So today's date is, so it's given to us in the question that today's date is somewhere. Let's remember. So you can assume that today is 1st of November 20x3. Today, today's date is 1st of November 20x3. So duration before investing. That is between today and the day we are investing the money. That is November 1 to February 1. Is November, December, and February. That's 3 months. Do we agree? I think we should agree. So this is just basic information that we have derived from the question. So we have our hedging strategies. Hedging strategies. We have three major hedging strategies here: the forward rate agreements, the futures, and the options on futures. So forward rate agreements. We have the futures options. So now we begin to solve. So we pick the first. So let's do something more. Here is amount, and here is rate. Because we need this information. We need this information later on, and it will help us out. So first option, first one is our forward Any questions so far before we go ahead? Any questions so far? Okay, I would assume no questions, and I would move on. Question here says, for forward, Voblaka Bank has offered the following FRA. FRA is forward rate agreement. FRA rates to R1 Co. 1 to 7, 3 to 4, 3 to 7, and 4 to 7. What this means is the first number talks about the amount of months between now and when you want to invest. And the second number represents the amount of months between now and the maturity of our investments. So if you look at our Excel, we know that from here we have 3 months. We have 3 months before our investment date, and our investment is for 4 months. So we would know that from now to the maturity of our investment, we have 7 months. So we would pick the 3 to 7 FRA because it is 3 months between now and the date of investment and 7 months between now and the maturity of the investment. So we write it using 3 to 7 FRA units. How much is it? 4.82%. 4.82%. Then, if you go back to the question, you will see a comment written at the beginning. They said Awanko can invest at the relevant interbank rates less 20 basis points, meaning that whatever rate that's available, they would invest at 20 basis points less than the rate. So this amount is all called the credit spread. So less credit spread, which is minus 0.2%. So you add it together, you have 4.62%. This amount here is our FRA rate. As simple and straightforward. Now, this is just the first part. We now need to show the efficiency of this rate. Remember, we said, okay, I think Z will remember that one of the characteristics of the FRA is that it locks in our rates, meaning that we would be paying the same amount of interest irrespective of how the market moves. So let's begin to clarify that. So simple test. So assume interest rate increases by 0.9%. So interest rate increases by 0.9%. As given in the question, since we are investing interest received on investment would be, what is the interest rate in the market? Interest rate is currently at 4.09%. Do you agree? 0.09%. Then we are estimating a 0.9% increase plus 0.9%. Yes, and we also know that there's a credit spread of 0.2%, or let's just add the credit spread of this guy. Everything combined will now be multiplied by how much are we borrowing? 48 million. For how long? 4 months. Let's put it 4 here. 4/12. Right? So let's put 4 here and put 3 here. So we can easily link them whenever we need them. So you can see in this case that this is the amount of interest we would receive if we are investing our money. Then gain or loss on FRA. So now it's quite simple. We agreed that the interest rate will be 4.82% and we are investing. So if the interest rate is going higher than that, we have to pay the exchange. And if interest rate falls, they balance us. So think of it like this: you are booking an insurance plan. If interest rate goes down, they settle you for your losses. And if interest rate goes up, you settle them for your gain. So it's simple. We just have to calculate whatever is our gain or loss on the FRA. So this is how we do it. What is the rate currently? We agreed 4.82, right? 4.82% minus, minus. Current rate is 4.09%. Then we are estimating it to increase by 0.9%. Right. So this will multiply by the amount we are borrowing times the period over 12. Any question? I don't expect the question. So this is the net amount we are getting. So annualize. Hi, are you trying to speak to me? Hi, if you are not talking to the class, help us keep your mic under check. Thank you. Thank you very much. So this guy over this guy there, and I just turned the period upside down times 12 divided by 4. This guy should come out in percentage. Percent. You see, our interest rate is still 4.62%. Now, let's assume, let's just copy everything here like this so we'll not have to stress ourselves and paste it down. As the interest rates decreases, so we're just going to adjust, decreases by 0.9%. Our interest rate will be 4.09 minus 0.9% plus our credit spread. Credit spread is this guy. Multiply by B9. This is B9. That should be this guy. Then this guy multiplied by 4. Hope we are all good here. So remember what we are saying. 0.49, 0.049, 4.09 minus 0.9%, which is the expected reduction in interest rates, right? So we are saying interest rates is reduced by 0.9%. Then you have to factor your credit spread of 0.2. Then that will now give us our actual net interest. Then multiply by B3, which is the amount we are borrowing for how long? 4 months out of 12 months. Makes sense? Good. Then the same way, what is our gain or loss? Our gain or loss is 4.82%, which is related to agreed minus 4.09%. Then this guy will not be minus 0.9%. Everything multiplied by, instead of B9 to be B3, and rather than C12, it will be C6, because of we are going back to the numbers we highlighted before. So this way we now have our gain or loss. So in this position, we have a gain. So this guy also will be B3 times step number 4. So you can see that once you are losing in the market, you are gaining on your FRA. Once you are gaining the market, you are losing your FRA. So whichever case you choose, your rate is still fixed at the same amount. Let's test it. This rate is equal to this rate is equal to this rate. Should tell me true. Okay, false because of approximation difference. But basically, you can see it's 4.62 across board. So, any questions? Any questions? Okay, so let's link up. Forward rate is equal to this amount. Rate is equal to this rate. Good. Then the next option we have is our futures. So let's pick it. Oh, good. So what do we have in our futures? So we go back to our question. Let's read. Where's it? So the following information and quotes are provided from an appropriate exchange. Remember, we said that futures are exchange traded, meaning that they are sold on the exchange market. And it means that it does not carry counterparty credit risk. Counterparty credit risk is the risk that your counterparty or whoever you're in transaction with will default in settling their contractual obligation. This risk is fully inherent in your forwards because it's always between you and another party. But for the futures, you might not necessarily see it because you are dealing in an exchange. So you could easily sell the transaction to any party at that particular point in time. And due to the benefit of marking to markets, you get to see the gain, you get to cover your gains or loss on a daily basis. So you don't have to wait for the final day for gains or loss to be posted, which is something we see in the forwards. Now, let's move on. So, 3 months futures valued at $2 million contract size. So let's begin to write it. Next point, futures are standardized contracts. Remember, so it means that they always have a particular size and duration. Futures are always 3 months, 90 days, and they always have a standard size depending on the contract. So this one, our contract size is 2 million contract size. is 2, 1, 2, 3, 1, 2, 3. Good. What next? Let's move on. Prices are quoted in basis point of 100 minus annual yield. What does this mean? It means that your price of your futures is always 100 minus the current exchange rate. So see your exchange. So as our exchange rate is currently 4.09, the price of your future today is estimated to be 100 minus 4.09. Make sense? Yes, makes perfect sense. So now it means that all these features are priced 100 minus particular rate. So if you do 100 minus this amount, you get the rates they are implying. Now, remember, we always said you should buy contracts that would always exist as that, or would be in will still be functional up until the day of your investment, meaning any contract that would mature or expire before your investment date is not valid. Remember that point, just put it in your mind to become useful in future. So our contract size are 2 million and these are the rates. So now that information I just gave you. When are we investing? We are investing when? We are investing in investment date is February 1. So all contracts before February 1 are not valid. So that means your December 20x3 contract is not valid. And since March is the nearest after your February, it is wise to use the March because it limits the exposure you are facing. People could say, buy the dual futures and use, but remember, futures generally face basis risk. Now you have to go back to our initial class to understand what does basis risk mean. Basis risk is the risk that your estimated movement in price will not go in line with the markets. So markets might move faster or slower than
Good
what
afternoon.
you. Hi, good afternoon.
Please, how did you get that 27,200?
27,200. Ah, you're taking us 17 years backward. Can you see my formula?
Okay, 4 minus 4.8 minus this 4.6.
Hello,
Hello.
I can hear more than one voice. Let's take it one by one. It's one by one.
Hello.
Hi, please wait. First person first.
Please, just put it under that form. Let me just put it in that formula. Let me just see how you got
Put
it.
it where?
The formula. I just want to see how you got the gain or loss.
This is it.
4.82. 4.82 minus 4.09 plus. Okay, please put your cursor under 766. Let me see. 766,400. 766,400. 4.09 plus. At what point do you incorporate that basis point, that credit spread rather?
Credit spread is incorporated when you are actually investing.
So you don't inject it inside this formula.
Is here.
Where is it? Sorry, under where?
See it here. Interest received on investments. That B21 is credit spread.
B21. No, I mean under that interest received on investment. I'm seeing the normal interest
4.09
4.09 plus the
plus,
increment.
yes, plus
Plus
B21. B21 is your credit
B21.
spread. That's why I linked
B21.
it so you could easily remember where I got it from.
Okay. Times
Okay.
this times. Why is this 6/12 instead of 4/12?
C6 is a cell. This is C6
Okay,
here.
6. Okay, 4/12.
Yes.
Okay, please go to the second one. 22,700. That's 4.82 minus this. Now, my question in this gain or loss, why are we still putting the increment, that's the interest increment, if we have already put it of 766,400?
Because you are trying to measure your gain or loss in the market in response to what you are investing. You understand?
Because I feel since you've incorporated it under that interest, that's 0.9. I'm not sure it should be above.
Okay, so remember I said my first statement when I started this question when solving it, said that when you are hedging interest rate risk, you are buying a hedging instrument separate from your investment or borrowing or separate from your transaction. Do you remember?
Yes, I can.
Good. So I said you buy a hedging instrument today, and that hedging instrument will be different from your actual transaction. So we bought a hedging instrument, which is the forward today, to say, okay, we want to fix the rate at 4.82. Then in 3 months' time, we went to go and borrow. So what we are saying is this: the rate is currently 4.09 today, right?
Yes.
So as we are estimating, if interest rates increase by 0.9%, that means on the day we are borrowing, we would actually be borrowing at 4.99, which is 4.09 plus.
Yeah, 4.99. Okay, okay.
Good. But remember, you have a credit spread of your own, which we have been told that you can only borrow at 0. So you can only invest, not borrow. You can only invest at 0.2% lower than the market.
Yes.
Good. So that is your normal investment. That is a standalone transaction. But remember that you already bought a hedging instrument at 4.82. And if you have done SBR, you would realize that in IFRS 9, one of the features of derivative is that the gain in one party is always equal to the loss in another party.
Yeah, it makes
Well,
sense. You can continue. You can
okay,
continue. I've gotten
good.
it. Yeah.
Yes, Z, I think I have a question from Z too, so please talk to me before I move on.
No, I'm done with my question. I think the next question is from the next person.
Oh, sorry, second person. Next question before we go ahead. Next question before we go ahead. Okay, I think person has dropped off, so let's move on. Wow, there's been a lot. Okay, back to my question. Behave now. Oh. Yes, so I said we cannot use December futures because they would expire before our transaction date, and we don't use March because March futures would is directly after the anniversary date, and it reduces the amount of risk we are facing. So that means we will be going with the March futures. Then question we asking ourselves is now is, what are we doing with these March futures? Are we buying or are we selling the futures? Now we are investing and we are not borrowing. So where you are investing, you buy the futures. Does that make sense? You buy the futures, and when you are borrowing, you sell them. So, okay. by March futures at 94.76. No, I need only one dot or two dots. So now, you remember they told us that we should assume that basis risk does not exist. So we would assume that our basis movements will go at an equal manner during the period. One. And two, which is the most important part, the fact that this our hedge is not a perfect hedge. What do I mean a perfect hedge? The instrument is not expiring on the exact date of our transaction. That means we have to sell it before it expires. Now, that means that the rate, we'll have to estimate the rate it will be on the day we are selling it, because it, like I said, has not yet matured. So that means we would have to get our calculators and solve. But before then, let's calculate the current future price. So current future future price. So what's our current future price is 100 minus what is our current interest rate, 4.09%. Do you agree?
Yes.
So then the next thing is we look at is basis at inception, the expected movement we want to see in our risk or in the features. Basis at inception. So what's our basis at inception will be what's our current market price? What we calculated, which is this guy, minus what we expect it to be at the end, 74.96. So we expect our basis to move by 1.15 between now and the expiration of this future. But remember that this future, we will not hold this future till maturity. We will sell it midway. So we need to calculate what we call unexpired basis, meaning the basis we will not face. Unexpired basis. Unexpired basis is how long is this transaction? Today is November 1, right? And the feature is expiring in March. Remember, we always said that features would always mature at the end of the month. So we are looking at 31st of March. So November 1 to 31st of March is 5 months, right? However, we are only to hold this transaction for 3 months. So we have
So,
2 months.
sorry.
Yes, talk to me.
I noticed you picked March futures,
Yes.
but the question said invested until it requires for a large project on 1st of June.
Okay.
My question is, why didn't you pick the June instead of the March?
You know, we are trying to hedge our rate, the rates between now and when we are investing. Because, you know, once we invest, we have locked in the rates.
Okay, and the investment date is February, right?
Yes.
Okay, it makes sense now.
Once you invest, the rate has been locked in.
Okay.
Okay, good. So an unexpired basis will be 2 months out of the 5 months multiplied by this guy. So this is our unexpired basis. So whatever we are calculating, we would always have to deduct this guy out of them to show that we are not bringing in this amount in our computation.
Another question, how did you get 0.46?
Okay, let me show you.
4.76.
2
So
months.
so the 2 more months is from when to when?
Remember that our transaction is we have 3 months between now and the day we want to invest, right?
Yes.
But the instrument is from now to end of March.
Okay, sorry. Now is
November 1. Today.
Is October, abi? Is it
November 1.
1st of November? So now till February is, I think, 3 months.
February 1 is end of March, end of January.
Alright, so now that's 1st of November, December. That's 2 months, right?
Yes.
2 months. Then that five is
No. Now is November 1. So November, December, January is 3 months.
I'm trying. So 1st of November till end of November is 1 month. 1st of December till end of December is 2 months. Then 1st of January till end of January is 3 months, right?
Mm-hmm.
Then how did you get 2 months?
1st of February to end of March.
Okay, 1st of February till end of February, 1 month. 1st of March, that is 2 months. Okay, till the futures date, right?
Yes.
One we collected, that's 2 months. Then
Yes.
5 from when to when?
What is it? 5 months is November to end of March. That is
Okay,
how
5
long
today
before
till
the
okay. Please, can you just take things slowly because it seems you're rushing.
taking it
So
slowly.
unexpired.
Okay.
Okay.
Can I go on?
Yes, please.
Okay.
So 1st of February. That's 2 months. It's 3 months. Okay. You can continue.
Okay. So now we have two scenarios that the price will go up or the price will come down, right?
Yeah.
Good. So let's solve.
It's equals to 5 months. Okay.
Increase by 0.9%. Then decrease by 0.9%. So remember we said we are buying now and we are selling. So we are buying the contract now. So If you buy now, we sell it in the future. So what is our exercise price? Exercise price. Exercise price in brackets. The price we buy will be how much? 94.76, right? That's the future price.
Yes,
So
94.
94.76. Good. Then
Prices.
underline price.
Thanks for drawing you back, please. Sorry. That
Okay.
future price is 100 minus what?
100 minus interest rates.
That's 4.09.
Yes.
Yeah, 100. Okay, you can carry on.
So we have exercise price and we have underlying price. The price we buy and the price we sell. So we already have the price we buy, we have to compute the price we sell. The price we sell will be the price at the transaction date. So is one of two things. Remember, we said the price of a future.
0.15 times 2.5
So price of a future is calculated this way: 100 minus the interest rate as at that date, right? So if price increase, will be 4.09 plus 0.9%, right? That's the price that day. Then remember, we have unexpired basis, which is this guy.
Yes.
So this will
Yeah.
be the price there. We just copy and paste here. Then when the price decrease, will be this guy minus this guy. Do you agree?
Yes. Yes.
So let's do simple maths. If you buy at 4.76 and you sell at 90, if I sell at 94.76 and you sell at 94.55, are you gaining or losing?
If you buy
Yes, price you buy at 94.76 and you are selling
and
at 4.55, are you gaining or losing?
you are losing.
Okay, so it's simple market. The price you sell minus the price you buy. Then the same way on the other side, right?
Okay. So for let's say if you are investing, if you are receiving money, it's comparing buying and selling.
At every point in time, it's always buying and selling. You buy a future and you sell it at the day you need it.
Okay, what about if you are now paying? Is it the reverse?
If you are borrowing,
Borrowing, yeah. Is it the reverse?
you sell today and buy back in future.
So it's the reverse.
Yes. Today you are buying to sell in future. If you are borrowing, you will sell it today to buy it back in future.
Okay, so
Oh, what is good?
0.9% decrease 0.9%. So exercise price buy and sell. Okay. So 96.76.
Okay, let's go ahead. Okay, you are little just behind in this class, so let's continue. Now, the next thing we'll look at is our market return.
Can you put your cursor under 94.55? Let me see. 100 minus 4.9 times basis. Okay, you can continue. Thank you.
So one more thing we need to calculate is tick size. Tick size. Tick size is the value of the smallest change in an instrument. What do I mean? Tick size is the value of the smallest change in an instrument. So if there is, so let's say for example now, if you buy shares in MTN and you buy shares in Airtel, let's assume MTN share price is 1,000 and Airtel share price is 500. You know, if Airtel shares fall, if they both fall by 5%, the value of the falling is different, right?
Yes.
Because one is losing 15 naira, another person is losing 25 naira. So we need to look at, okay, what is the value of the movement in our instrument? That's what we call tick. So tick size is value of your contract multiplied by 0.01%. 0.01% is the smallest movement in your exchange rate or in your interest, because there's practically nothing below, because you know we always assume two decimal place, so this is second decimal place. Then the contract is standardized, so it's always 3 months, right? So 3/12. So $50 is the size of a tick. Does that make sense? So
Okay.
how many? So number of ticks in gain or loss. Yeah, made a mistake. So it's simple. This guy divided by 0.01. Make sense?
Hmm?
This is what I did.
Which guy?
Did you see what I did? This is 0.01, which is 0.01%. That's what I did. So now,
I'm seeing 0.01.
yes, 0.01%, 0.01. You know,
But
everything
I
everything
thought
here is in numbers, not in percent. You thought
I
what?
thought I thought stick size is in 10,000. That's 0.0001.
0.01%.
Okay, 1%. Okay. That's 0.0.
0.01%.
Okay. What about the 3/12? Where will it come in?
3/12 is because your contract size is always standard. Your client is always standardized.
Okay. It's quite confusing, but you can go ahead.
How long is the duration of your future?
4 months now.
No, that's the duration of the investment period. Your future is how long?
2 months, 2 months,
3 months.
3 months.
Yes, remember I said your futures are standardized contracts. December, January, June, September, December, March, June, September, December, March, June, September, December, March, June, September. 3 months.
3 months. Oh, okay.
That's 90 days.
Okay.
So that's the value of your tick. Now let's move on. Value of gain or loss. Huh? Is simple, is equal to this guy multiplied by your tick size. Make sense?
Okay.
Remember, multiplied by your tick size. Then one more thing we need to add. Yes, I just remembered. We need to calculate number of contracts we are buying. Number of contracts we are buying. So remember, we are trying to hedge 48 million, right?
Yes.
So, and the contract is 2 million, right?
Yes.
So I know normally you just say you say, okay, we are 48 million. Oh yeah, where's 48 million? Just divided by 2 million, no time. Shey, that's easy thing to do, right? Is this one should be a number, not percentage. This is 24 contracts. Shey, quick, we move on. I know that way you're thinking, right? Don't lie, is what you're thinking. Respond. Hello? Is she there?
I'm just looking at what you are doing. Maybe later I'll look at it well.
No, I'm just like on a good note. You want to invest 48 million and the contract is 2 million. You just say, oh yeah, how many 2 million is 48 million? Let's multiply 24. So you just buy 24 contracts. 24 contracts combined times 2 million is 48 million, right? That is the simple logic. Do you agree?
Yes.
Good. But remember that you are borrowing for a period of time. So you need to factor the time value of money concept. We are borrowing for 4 months, right?
Okay.
We are borrowing for 4 months. Meanwhile, the standardized duration of a contract is 3 months.
Okay.
So you need to now put in the weight of the period you are borrowing for, because you know the longer the period, the longer the impact on you, right?
Okay.
So if you want to do something big quickly, you buy more contracts. If you want to do something small, you buy less contracts. So actually, the amount of contracts we need is 32, because it is your amount you are investing divided by contract size times the period you are investing for divided by 3. 3 is the duration of the contract. Make sense?
Okay.
Let's write it somewhere. So amount to be invested or borrowed divided by contract size. Now, the multiply by duration of transaction divided by contract period. Good. So we are buying 32 contracts. So we are saying the number of ticks multiplied by the value of the ticks multiplied by your number of contracts. That makes sense?
Yes, it does.
Good. Then now we now bring in market return. How much will you gain if you are to invest this money in the market normally? This point, we will not bother trying to solve it. We just want to copy it from what we have done upstairs. We have copy. Market return, if there's increase, is this guy, right? The market return, if there's reduction, is this guy. Any question, then you add this guy plus this guy. It should give you the same number. In this case, we have confirmed that we have hedged our future. Why? Because we know that futures locks in our rates also, right? Do you agree? Future locks in our rates. So this is the amount we are expecting. So when you annualize it, now because this guy divided by B3 multiplied by 12 divided by how much? C6. So turn it to percentage and give it 4.58%. So I lock in my B3, I lock in my C6. So I copy and paste it here to confirm that it's the same thing. Yes. So now we know that futures will give you an interest of 432 and equals to be 59, 4.58%. Any question? Any question?
No question for me.
Okay, so we go on. Class is getting on nice. Go to our last point, which is our option on futures.
10, 20.
So what does the question say on option on futures? Let's read. Question said something significant. Options on 3 months futures. Question, remind me, what is the characteristics of options? Let me see if you remember what you did from last class.
It comes with premium.
It's what?
It comes with premium.
Okay, what does the premium do?
It's a cost, so it will reduce the option.
Okay, it's a cost. Yeah, what else?
Um,
What else? What else? What else? Okay, so let's move on. I think you get the idea. So options on 3 months futures is 2 million contract size and option premium are in percentage. Question: are we buying call or put options? Is our test series. And which period are we buying for? Because obviously you always buy options generally. So let me help you that part. Buy, okay, call option or put option, and which of the months are we buying for? So tell me the
Okay,
months,
we
tell
are
me the
buying
time.
call option
Call options, okay.
for for June.
Why June?
Mm, because the option is on 3 months
Mm-hmm.
from the future, right? And I
Yes,
think the
we
future
have December, March, and June. So why June?
option on 3 month futures. I just feel it's a month after the future. Kind of.
When is that transaction date?
February.
February, okay. So remember we said it's always advisable to use the option closest after your closest before your transaction date. So closest after transaction date to minimize your basis risk,
Oh,
right?
okay.
So we are saying since the transaction date is February, pick the one that is immediately after February to reduce your basis risk. June can work, but the question will now be why are we choosing June instead of March?
Okay. But is it call? Is it call option?
Yes, it's a call option. We are investing.
Okay.
Call options are for investments, put options are for borrowings. So by March, call options. So the same thing we did here, number of contracts. So number of contracts will not change. So just no. Number of contracts will not change. Just to copy and paste. Okay. Number of contracts will not change. Same thing here. What else will not change? Number of contracts, yes, this guy will not change because they're both to 2 million. Oh no, let's resolve by ourselves. So in case someone can assume that okay, that they must always use the same thing. In this case, if it's not 2 million to change, so but let us see forward. What else? Tick size. Tick size is this guy. Tick size is. And I think I will link my tick size. So tick size is always is this guy multiplied by 0.01% times 3 over 12, $50. Then this guy would equal to this guy divided by B3 divided by 6 divided by 12. No. Mistake. Multiplied by 6 divided by 3. Sorry. Number of contracts is B3 divided by this guy. Yes, times C6 divided by 3. Yes, 32 contracts. So we have major information we need. Then in this case, we have two contracts. We have two options, the 94.5 and the 95.0. So we need to understand which of the contracts or which of the options will be beneficial to us, right? So this is what we'll do. We'll do first template at say the first part is where we add option price for what's the first option price? 94.5. So these two will be merged together and centralize. Then just copy and paste it here. So this one will be 95.0. Then we now have the same increase by and decrease by. Makes sense? Decrease by, decrease by. So this way we copy the same template we have here down to here. Just copy and paste and adjust. Shalom. Yes, yes. Need to add one more line here. Okay, so we'll solve them simultaneously. Make sense? So price we are buying at 94.5. That's the future price. Then here we are buying at 95. That's the future price. So I like putting my 2 zeros. So yes. Then underlining price. So the underlying price is the increase or decrease. So just link it up. Where price increase, it will be this guy. Where price reduce, it will be this guy. Right? So the same thing here, and we just link up. So now the same issues, just copy and paste. No significant difference because we want to know our pricing strategy. So now, because we are dealing with options, we have the advantage of a decision. So, generally you'd always buy a transaction that favors you, right? So in this case, you only accept a transaction if it leads to a net gain to your position. Meaning if you are gaining, you accept the option. If you are losing, you leave the option and go and buy from the market because you should not be willing to lose on an option. Meanwhile, you can get better return from the market. So This is what we'll do. Decision, yes. You are investing, you're taking the yes, you are exercising. And yes, this one is a no because we are losing here. So the ones that are yes, you pick the value of your tick. This guy divided by 0.01. Copy. In this guy is a no, so you will not use the option, so the option has no gain. The same thing, this guy multiplied by this guy multiplied by this guy. So you copy, you paste, and you paste. Good. There's one more thing to bring in. The cost of our cost of our options. So option premium.
Sorry, the 8,000, did you multiply it by the tick size?
Yes, I did.
With what again? With the
Number of
number.
contract.
Okay, all right. You can go ahead.
So market return should almost be is the same. So just easily link that one.
Please, sorry to take you back. Just
Yes.
briefly explain that market returns. The 766. You multiply the actual 48 million, right?
Mm-hmm.
No, go down. You are going up.
Well, come in. Taking to where it started from.
No, not this one. Actual returns on futures.
Yeah, this is where everything is linked to.
Please let me see put your cursor on that 766. That's all I just want to see.
This is 766 now, yes or no?
Okay, you picked the forward actual returns for futures.
This is your actual market return, irrespective of your hedging instrument.
Oh, okay.
Remember, I said your hedging instrument is a different activity than your transaction itself. Meaning that you buy whatever hedging instrument you are buying now, it is different from you investing. So your investment is with the bank. Your hedging strategy is with any other person. So one thing is sure, whatever happen in the market will still happen. You face it. The only difference is the gain or loss you are getting on your hedging instrument.
It makes sense now. It makes sense. You can continue.
Okay. So option premium. What is our option premium? They said we are buying match call option. So we have 0.43233%. It's simple. So I will do two different ways and we will find out how to that they're the same. 0.432% multiplied by B3. B3 is amount we are borrowing, right?
Yes.
The amount we are borrowing, how long are we borrowing? for C6 divided by 12.
6.
Do you agree? Remember, it's a cost. Do you agree? The same way, if there is a decrease, so just copy this guy. Then the second way to check it is 0. Second option is 0.121. You just do 0.121 divided by 0.01 to get the number of ticks you have. You multiply it by your tick size, multiply it by the number of contracts, whichever way you get. So this is a cost. So you should have a minus here. Any question? Any question? So you get your sum, the summation of these three guys, and you drag it to the end. Then analyze. Will be this guy divided by V3 times 3 divided by 4. So this guy is percentage 2 commas. B3, I want it locked. So I paste this. Any question? So option
What did you get if you net it? Is it 76,578?
I do what?
If you deduct the premium from the, let me see what you got. Sorry.
I'm coming.
Cents. But just hold on. Can carry on, sir.
Okay, so we now have all our numbers and we just decide. So we have our return here. No, this guy. Yeah, this guy is equal to E82. Then the second one is if that E82. So now we are done. What is your hedging strategy? that you are recommending and why. Now is your turn to talk.
Since we are receiving, I think we'll go for the highest.
Okay, why are you going for the highest?
Because we are receiving. So we want our money to be there.
So next question, what is the risk attached with going for the highest?
I think one of the risks is premium. You're exposed to premium costs.
Okay.
And
so you are saying we should go for this second option, right? 4.67.
6 So
Okay,
yeah,
so let's calm down. That is this one.
that's the second option.
Okay, so what's the risk attached?
I said you're exposed to premium costs.
Mm-hmm.
Exposed to, since this option is based on some of the calculation, I think is based on future. So you're still exposed to basis risks.
Mm-hmm.
And I think
So
basically that's the two type of risks.
question, what happens when the rate falls?
Which rate, sir?
Interest rate falls.
So is you won't exercise it, then you're exposed to that initial cost that you've paid. Oh,
No,
but it's like a guarantee that. Okay, sorry, go on.
you said we won't exercise if interest rate falls. That's what you said. But that's not true. Because when rates fall, we're exercising, we are saying yes. This is what we wrote yes here now, meaning that we're exercising. Yes, that's why we have value of gain on. Because there's no loss there's no loss in the future in an option. So hey, sorry, I've not conducted. There's no loss in an option, so it's just only value of gain. Yes. So you said we should pick this option. Then remember that we only get 4.67% if interest rate increases, right? So my question is, what will happen when interest rate falls by 0.9?
Then we won't exercise it.
You are contradicting what we saw because we decided here that our decision rule is yes, we would exercise. Meanwhile, funny thing is, we are saying if the interest rate increases, we will not exercise because we will leave it and go and buy from the market, or would leave the option to elapse and go to the market. So actually, we are exercising here. But my question is, what would be our net interest if interest rate falls?
Yeah, I don't know then.
It is written in the question here, now 4.22%. You say, how did you get 4.67?
Oh, okay, yeah. So there's no need exercising that 4.67 now because it's a no. Am I correct to say that?
No. So now, go back to the basis. What is the aim of risk management?
To reduce the risks of paying, kind of reducing the risk of paying more or receiving
Okay,
less.
good. So now you are saying that you want us to pick this guy because this guy gives us the best option, right?
Yes.
And now this one, this would only happen when interest rate goes up. My question is, what would happen when interest rate comes down? You have to tell me what will happen.
If it comes down, maybe we'll take
No,
another.
what would happen, not what is your decision.
Okay,
You
what will
said
happen?
Wait, you just told me that if interest rate goes up, we would get net interest of 4.67%, right? That's what you
Yeah.
said. So if interest rate falls, what will be our net return?
4.22.
Okay, now we are going somewhere. Just follow my questions. 4.22%. Now, this 4.22%, how does it compare to our other returns?
It's very low.
It's very low. That means we are so if we pick that decision you chose, we will face the risk of either 4.67 or 4.22, right?
Yes.
Good. Question now is, have we effectively mitigated our risk?
No.
Why?
Because we are still exposed to receiving lower.
Okay. So what does it
If
mean?
it means that we will not take that option then.
So since this option does not work, now, which option would you recommend?
So I'll just recommend for the forwards because you are not
Why are we using the forwards?
you're not really exposed to these complications.
No, you have to give the reason. Remember, this is SFM. You need to
I
give
know.
the reason why you are doing what you are doing. You are presenting to the board. So telling them the number on the screen, they can see the screen. Why are you choosing that? Is where the mark comes from. That's why I'm pushing you to get the answer. I can easily tell you and you move on, but I want you to see the full picture.
Yeah, you've actually shown the full picture, but you are not actually exposed to those complications that we listed earlier on. That's those weeks, basis
Complications like
the basis weeks and options, and
okay,
not obligated to either, and you don't really have any obligation as regards options. You have some kind of obligations
such like
to exercise the weeks, to pay options, and also but yeah, you don't really have any obligations.
okay. So
Just the bank and do some kind of
my question is, what are the risks attached to forward as a form of hedging? Every instrument has its own risk. So you need to talk about that one too.
forward risks. I have no idea for that forward, but I know the risk is kind of lower.
Remember we said forward is faced with counterparty credit risk, right? Because what's the risk that essentially the risk that your counterparty might not be able to pay.
Oh, okay. Yes.
For example, in this forward, if rates goes down, our counterparty has to pay us 260K. Question is, what if they cannot afford to pay 260K? What will happen?
So that'll be a loss for you.
Good. So is it lost to who?
So to me,
So you see that is a risk, right? So you have to explain that risk also. Make sense? So what else are the characteristics of forward that we are going to face? Now, these are all the things you put in your report that you are presenting to the board. Solving will not give you enough marks because most likely when you're a consultant is the junior accountant that do all this computation. You, the senior or the manager, are the one discussing the numbers. You're not the one doing the Excel.
Yeah, it makes sense now.
No, there's a final question. What else is the risk we are facing in this case? There's one more thing you're not mentioning.
Okay.
Because you first chose the option of B, and we saw that the risks were too high, and you're like, no, let's go with forward. But also forward has its own risks. You show me the benefit because it gives us 4.262%. Okay, the risks. I want to see all the risks. Because management has to make a well-informed decision. So you've mentioned the fact that, okay, that it gives us 4.2, which is high. Then we have discussed also the point of counterparty credit risk. Now, even before we get the counterparty credit risk, how do we mitigate it? Are you there?
Yeah, I'm here. I'm thinking.
So remember we said in our first class that counterparty credit risk can always be mitigated by getting a guarantee from the bank of the customer. And most times it's always appreciated if you are dealing with the bank. So in this case, we are dealing with the bank directly. So we have some form of hedge because counterparty credit is reduced because we are dealing with the bank. Make sense?
Makes sense now. So it's like
Good.
over the counter, right?
This is not this is over the counter, yes, because it's not exchange traded, but we are dealing with the bank, so we have some form of comfort. So
Right.
what else is I think okay, let me just help you out. The fact that we are taking the forward mean that all opportunities for upside benefits will be eliminated, meaning that even if exchange rate goes up, we are stuck with only 4.62%. Does that make sense?
Yes.
Does
Makes
it
sense.
make sense?
Yeah,
So
it
we have
does.
to show the man that, okay, oh, that this 4.66%, oh, it can never change. Exchange rate
Yeah.
goes up or come down because of the characteristics of forwards.
Okay.
Makes sense. So
Yeah, it does. Can you
if
remind aside the basis risks that is affected with futures, which other risks is affected with?
cash flow, you have to do daily marking to market, meaning that where you are making a loss, you have to be making daily deposits with the exchange. And because of these gains or losses are not predictable, you cannot plan for this cash flow. So it would distort your cash flow planning or cash flow forecast, and it can put a strain on your liquidity. Imagine a position where you make very huge losses in a day and the next day reverses. That day made that loss, you must pay. You understand?
Yeah.
Then if it reverses the next day, you will get it. That money will remain with the exchange. Do not pay back to you. Oh. So that money will block with the exchange until there's a loss that comes to clear it out. So you might make a very big loss the first day, and when you make deposits, then when you that loss start reversing to again, that money will not come back to you. So now there is a gap in your cash flow. Does
Yeah,
that make sense?
yeah, it does.
Good. So that is the like, and like we always say, features just like forward, it eliminates the potential of any upside benefits because it locks in your rates. So if you see for our features here, our rates are locked in. Then remember, like always, we are faced with basis risk because we've assumed that our unexpired basis would only be 1.15.
Okay.
If this basis, so our unexpired basis is 0.46. If this risk changes, if number changes, everything change. For example, if this guy becomes 1.68, you see our rate is reducing.
Sorry, I want to ask for, I don't know if this class can be shifted going forward to maybe 12 to 3 because this timing
Ah,
is
I'm not the admin, I can't control that.
okay.
But I think you should just sit there. So, any question?
No, no for me now.
Okay. So that
But
is it.
you can start teaching. I just need a break.
That is
You
the
can
end of our call. So we'll take a 10 minutes break and we'll return. Then we'll quickly solve second question. Kashiko. Can you hear me? Okay. Please let's read the second question so we can solve quickly. Are you there? Hello, are you there?
Yes, I am.
Yes. Please read the second question.
Kessie Co.
Yes,
Kessie
cool.
large multinational company with a number of international subsidiary companies. The centralized treasury department manages Kessie's Co and its subsidiaries. Borrowing requirement, cash surplus investment, and fixed financial risk management. Financial risk is normally managed using conventional derivative products such as forward, futures, options, and so on. Assume it's 1st of December 24 today, and Kessie is expecting to borrow 18 million USD on 1st of February 20x5 for a period of 7 months. It can either borrow the fund at a variable rate at SOFR plus 40 basis points or a fixed rate at 5.5%. SOFR is currently 3.8%, but Kessico feels that this could increase or decrease by 0.5% over the coming months due to increasing uncertainty in the markets. The Treasury Department is considering whether or not to hedge the money using either exchange-traded match option or over-the-counter swap option by Rosie Bank. The following information and quotes for USD match options are provided from an appropriate exchange. The options are based on 3-month USD futures, 1 million USD contract size, and option premium are in annual percentage. Match call, strike prices, and match puts figures given. Options price are quoted in basis points at 100 minus the annual percent yield, and settlement of the option contract is at the end of March 20x5. The current basis on the March future price is 44 points and is expected to be 33 points on 1st of January 2x5, 22 points on 1st of February 2x5, and 11 points on 1st of March. Rosie Bank has offered Kessico a swap on a counter variable rate at SOFR plus 30 basis points or a fixed rate at 4.6%, where Kessie receives 70% of any benefit accruing from undertaking the swap prior to any bank charges. Rosie Bank will charge Kessie 10 basis points for the swap. I think that should be the bank charge, okay? Kessie co-chief CEO believe that a centralized treasury department is necessary in order to increase shareholders' value. But Kessie new chief financial officer think that having a decentralized treasury department operate across the subsidiary company could be more beneficial. The CFO thinks that this is particularly relevant to the situation which Susin Company, a company owned by Kessie, is facing. Susin Company operates in a country where most of the company conduct business activities based on Islamic finance principles. It produces confectionery products, including chocolates. It wants to use salam contracts instead of commodity future contracts to hedge its exposure to price fluctuation of cocoa. Salam contracts involve a commodity which is sold based on currency agreed prices, quantity, and quality. Full payment is received by the seller immediately for an agreed delivery to be made in the future required. Based on the two hedging choices Kessie is considering, recommend a hedging strategy for 18 million USD borrowing. Support your answer with appropriate calculation and discussion. Then discuss how a centralized treasury department may increase the value for KSICO, and the possible reason for decentralizing the Treasury Department. Then discuss the key differences between Salam contracts under Islamic finance principle and future contracts.
Okay, what do you understand from what you just read? Is plenty information. Tell me, what do you understand? And we'd actually only be solving the A portion. Let's see how fast we can do that in 30 minutes. Because there are only 32 minutes left. What do you understand?
80 million USD. But the options there are either, I think option is number one, then swap. So we can hedge using swap or options. There may be futures, I guess.
Did you mention future in this question?
I'm saying option basis. Okay, yeah. Okay, no,
Did they
just option.
mention feature in the question?
It's because I'm saying match future prices. It's just option and swap.
Yes, options and swaps. Okay, let's do this. So we have two options. For the make life easy for us if to really have match. So it's either call or put. So question is, we are borrowing, right?
Yes, we are.
So call or put option, what are we doing in our life?
It's call option since you're borrowing.
Ah, ah, don't disgrace me. Oh.
Since you are borrowing, it's call now.
Yeah, are you sure? If I invest in call,
If you are receiving, it's put.
let me give you a spool. Let's go back
Do you
to our question.
do you mean the option?
Yes.
Okay, the option is the reverse, then it's put option.
Okay. Thank you for wiping away my tears.
No, I felt it's just the initial, like what we are doing. I didn't know it's the option. So if it's the option, it's the reverse.
So simple things. So I'll run very fast in this one because our time is gone. Today is 1st of December 24. Okay, on December 24. And expected to borrow, amount to be borrowed. Amount to borrow is 18 million on 1st of February 2025. Right. So it's 1st of February 2025 for a period of 7 months. Borrowing period, transaction period. Seven months. What else do we need to know? It can borrow funds at a variable rate of SFR plus 40 basis points or at a fixed rate of 5.5%. SOFR is currently 3.3, but Keshiko feels that this could increase or reduce by 0.5% over the coming months. Okay, we have what we need. So same way, let's go and copy and paste. Let's just ourselves. Hedging. Let's copy 2. So options or features. Then swap. So delete, done. So first one, option of features, paste it here. Okay, what does the question tell us? So options are based on 3 month features. Remember, our contracts are always 3 months. It doesn't go beyond 3 months. 3 month features with a contract size of 1 million and option premium are paid in annual percent. So it's simple, we just solve. We copy same thing we've done here. Practical level to we've done here. Huh? God is good. That's just ourselves. We paste and we run. Mm. So we have contract size. What's the contract size? What's the contract size? Contract size is 1 million. Then this is tick size. And this is number of contracts is 18 million divided by 1 million times 12 divided by. How long are we borrowing for? We are borrowing for 7 months, right? Are you there? Are you with me? 7 months divided by 3. 7 months divided by 3. 42 contracts. Let's put it here.
As if I was
Okay.
your template.
Ma?
It's as if I was steal your template. It's even making
Why?
more sense. Because
Why
the
do you
way you
want to do?
the thing is just automatically entering.
Until you now decide how to do it by, so I think you should do it by yourself. If you can do it by yourself and get it, you got it. I can easily do it like this now because I know what I'm doing.
Please, how can I have access to this template?
No, I'll share with you now. I'm not stingy.
Okay.
I'll share with you. This is the same exam we used last week now. This is last week classwork. So I just keep on using the same file. So at the end of the class, you would have
Please,
everything in one
beg.
document.
The beginning to the end, please.
Yes, just have everything in one
Thank you.
document. So we are buying match. Is it match? Yes, match put option, not call.
March. Okay, yes, March. Since the transaction is 1st of February. Yeah.
That's even the only option we have, sef. So it's not as if we have a choice.
Mm.
So here is 94.5, 95.5,
Okay.
and here is 96. So now we now have to do few things. So let us go here and copy all these things we did. All these things we did. Copy it.
Did you copy and paste all these templates, or we are adjusting it?
I copied and pasted. Don't worry. I copied and pasted. The numbers will adjust. Don't worry.
Okay.
Just give it time. Numbers will adjust.
Because
So
you know
by
the first question, the answer is still there, Abi.
yeah, just copy and paste.
Okay.
So ahead. That's because the option prices are quoted in basis point at 100 minus the annual yield. And assessment of the options at the end of the match. The current basis of the future is 44 points. And it's expected to be 33 points on January 1, 22 on and 11 on March. So it's reducing by 11 points. So now we automatically have our unexpired basis. So we don't need all these things. Sharp. God is good. So our unexpired basis. Today is what? Today is December 1.
December 1.
Transaction date is February. Is it February? I wish it was February. Transaction
February.
date is February 1. Good. So we are only faced with, say, is 22 points on February 1. Okay, so 0.22. Unexpired basis is 0.22. Nice. It's sweet. Okay, let's run. What else do we need? Then we now need to begin to adjust for where interest rates increase or reduce. So the same way, I don't like stress, so I'm gonna copy and I'll paste. This life is not hard. Just need to learn how to be wise. So let's paste. But now we need to change something. So buy March put options. So remember we are borrowing. So exercise price is the price we sell.
And buy.
And the line price is the price we buy it back. My God of work. Price we buy it back. So we don't confuse ourselves. So that means our formula will change. Do you agree? What else do? That means our formula here will change. Good. So that's for the meantime. So what is our formula here? What are we saying? We are saying 100 minus what is our current borrowing rate? Our current borrowing rate is about 3.8%.
Sure.
3.8%. Then
Yes.
interest rates can rise or fall by 5%, 0.5%.
Okay.
Then this is 43, should be actually be 41. Yes. Then copy this guy and paste it here. Then it should be minus this guy. Do you agree?
Yes, 5 points. 0 point.
No.
0 point.
3.8 minus. Yes. Do you agree? Right.
Yeah.
Do you agree with me?
Yes. So sell or buy. You sell this, I will buy
So
this.
This is the price we sell minus from the price we buy.
Mhm.
Are we making a gain? Yes or no? Simple. So this I'm making a gain here. Yes. This is a
Yes, it's okay.
no. This is a no. The same way, yes and no.
Mhm.
See, this thing is easy once you know it. The value of T. So the two no's, we are deleting them because we don't need them. Do you agree?
Yeah.
Good. So number of tick is this guy, and this guy is equals to this guy multiplied by Dave. This guy multiplied by number of contracts multiplied by tick size. So my tick size, I'll log my number of contracts, I will log. So I copy and I paste across board. Yes. The option on my premium. So let's make this two. Okay, so the first one is saying, what's my question?
0.662.
Say it again.
0.662
0.662.
and 0.902.
0.662 times
It's 2 times 100 times 25.
how much are we investing? 18 million times. How long are we investing? 7 months, right?
Yes.
Good. Then second one is 0 point what? 0.92902.
0.092.
902 divided by ah, ah it's already perfectly linked self. Ooh, like what I'm saying. I like what I see. I like what I see. So market return. Market return is, let's break it down, is equal to, is a cost, that means it's minus. What is our current rate? 3.8%, right?
Yes.
Then plus 0.5% increase, right?
Yes.
Bracket close. Do we have any market spread? Let's go back to our question. Go back to the question. Did they give us any spread? 3.8 plus 0.5.
I'm not sure there.
Yes, it can borrow funds at variable rate of SFR plus 40 basis points. So
Or
market
fixed.
spread is 40 basis points. This guy, the market close then plus
Hello?
0.4%. Yes, I'm with you.
I thought that was, you use that for swap.
Now we use it for
That
swap too. If we use it for swap, then for how many months? 7 over 12 multiplied by this guy.
18 million.
Yes, I forgot one. I forgot one brackets. 493K. Any question I have got 493K?
No, I
And
can't.
question. Ma?
Also. No question.
So let me just adjust my formula so I can lock it. Yes, I have locked this guy. So I'll just
What's it? If you lock it, it means nobody can alter it.
no. If I lock it, that means if I'm moving formulas, the cell I locked will not adjust.
Okay.
If I'm copying and pasting, it is assuming that the whole file is moving. But if I lock in a particular cell, if I copy and paste, it will still be referencing that same cell I locked it to. The formulas will not adjust. That particular cell I locked it to will not adjust. So in this case, we now have a number. So this is our cost. So yes, what does this mean? It means that our cost can either be this or this or this or this. Now, what does it mean in reality? So, analyze is equal to minus, let's put minus this guy, yes. No, let's put minus, let's put number. So the cost will come out divided by this guy. I lock my number times 12/7. Why? So I'm going for 7 months. Do you agree? Minus 35.34%. Good. So you can see this is how our rates are moving. So decision rule. Which of the option are we going for and why? Well, let's just put it two. Option A, option B. So this is our highest cost possible, and this is our highest cost possible, and this is our option percentage, this guy, and this is our option percentage, this guy. Right? Then swaps. Now, any questions so far? Because
So in this,
swaps, yes,
I have
ask. Swap is tricky, so I want your mind empty. Before go to swaps.
this. If you look at this increase and decrease, there is yes, no, yes, no. So if, for example, since we are broken, we always go for the lowest, which is 5.08. But since there is yes, no, like the case we had earlier on, what would you advise? Should we ignore it if it's
So
better? Well,
now this is something to understand. That yes, no is referring to the option, exercising the option. Yes, we are exercising our option. No, we are not exercising our option. That is different from the actual cost of borrowing. Yes, we exercise our option because we are making a gain from that option. No, we are not exercising our option because our option is now out of the money, meaning that if we exercise that option, we would lose. So we rather walk away. So if you notice, when we exercise the option, that means we are gaining. There's a gain coming to us, which
yeah,
is a reduction in our costs.
cost, yeah, yes.
So, and if you notice, we're only exercising the option when the price increases because we want to use that to reduce our costs. So, if you look at it now, so I picked the okay. Let me change my position. Let's look at it in a different manner. So let's look at our lowest cost possible. So if you use the first option, this is lowest cost possible, and second option give us the lowest cost possible. Right. So I think then we'll not explain the flip side because since you are borrowing, we want to get lowest costs. And if you are investing, you want to get highest benefits. So this is the lowest cost we can get. However, there's a risk that our interest rate will rise as high as this. So, and that we'll not do is the gap, this guy minus this guy for 98%. 0.48%. Good. So we have for this particular option A, we have a 98% difference in the a 98% spread.
Okay.
This is that spread. Let's call it spread.
Can you just write it there? Just
Yeah,
in
no,
case.
I am. This is our spread. See that spread. So any question now before we go to options? Swaps. Swaps is a bit tricky, but it's simple. It's very simple.
No question.
Okay. Now, based on this, what will you advise us to do?
Like I said, we'll go for the lowest, which is 5.08.
5 point what?
I mean, okay, you've changed it.
Yes, I have.
I will
Because
still go for the option B because of the
why?
spread.
Okay. So I would say you are a risk averse person.
Mm.
So you are saying you are willing to take the
Sorry, you
option.
can continue.
So I'll say you are willing to get an interest rate of 4.6% because you know you only be faced by a spread of only 4.84. But if you go down to, so let's look at the difference now. This guy minus this guy. So if you go down to if you go option A, your interest rate might fall to 4.36%, but you are now facing a possible what's the word? A possible spread of 0.98. That means you're not willing to trade a possible 2.4% for the risk of 0.98. That makes sense. That's what you're saying. Or am I not saying your mind? Hello? Are you there? Are you there? Okay, I can't hear you anymore, so I will move on. So the spread a option. This is spread. This is risk spread. Spread by option. Oh, this is nice. So swaps. This is how swaps work. This swap works. So for a swap, you have to take on a position that at the end you are exchanging your interest rates and you're ending with a reduced risk as compared to before. So what do I mean? So let's read. They said Okay, Awanko, and who is giving us the swap? Okay, Rosu Bank has offered Keshiko a swap on a counterparty variable rate of SFR plus 30 basis points or a fixed rate of 4.6. Okay, swap. So Keshi and Rosu Bank. Then this is fixed. This is floating. So they said Keshiko can borrow SOFR plus 40 basis points. So Keshiko floating SOFR plus 40 basis plus 0.4%. Then or borrow at 5.5%. Yes, the Rosu Bank offered a swap on the counterparty variable rate of SFR plus 30 basis points. So this guy just drag it down. This one is plus 30. Then
Fixed rates of 4.6.
4.6. So difference. Then difference here is how much?
0.1. SOF 0.1.
Good. So now, very important question. Who is gaining? Yeah, it's like yes. Yes. So the important question we are asking is this: if one party is gaining, if one party has advantage on both sides, you would deduct what's the word? You would deduct the gain from each other. Then if both parties have gain each 1-1, you would add the gain. Does that make sense?
No. Just
Meaning that,
illustrate it.
so let me illustrate it now.
Mm.
For fixed borrowing, who has the advantage borrowing fixed?
Rosu Bank.
Rosu Bank. For floating, who has advantage borrowing floating?
Rosu Bank.
That means Rosu Bank has advantage borrowing fixed and floating. Meaning
Mm-hmm.
that if Rosu Bank is borrowing fixed, it will be losing the advantage it has to borrow floating, right?
Yes.
Good. So net gain will be this guy minus this guy. Do you agree?
Yeah, the one teaching me. I don't have a choice.
No, like, do you agree with the number I just wrote on the screen? So I'm asking.
Okay.
Does it make sense to you?
This is the first time I'm doing it, so it's quite confusing. But you can go
Does the
ahead.
math, no, forget the knowledge, does the math make sense to you? Like mathematically, is it correct?
I don't know. I think he's correct. Yes.
It's correct now. Don't say you don't know now. We just did one minus this guy.
He's correct.
Give me hope. Then Back to the question. They said the bank will charge how much? Rose Bank will charge 10 basis points for the swap.
That's
Okay.
bank charge. Yeah.
Bank charge, bank. So minus 0.1%. Then
You said we charge 10 basis points of it,
yes.
not 0 point.
No, I'm coming. No, the formula is wrong. I'm adjusting it. Does this make sense to you now?
It does, yeah.
So no, this is called. This is no. Copy this one. Yes. Then this is gain on swap. Yes. Then gain attributable to caching. So cash will get 70% of this guy, right?
Yes.
Then to Rose Bank will be this guy.
30%. Okay.
So I want it into decimal, please. Good, good. Now let's prove that what we did is correct.
Okay.
Once we can prove it, we are done for today.
Okay. We won't tired.
Yeah, I mean, 3 hours is a lot, actually.
Comprehending what you're doing because I'm so tired.
So now this is where it gets tricky, but follow me. Don't complain, no, just follow me. So now the decision rule is whoever has comparative advantage the most would borrow first. What do I mean? Rosewood Bank has the most competitive advantage here, 0.9%. So you borrow at fixed. Make sense? Then Keshi will borrow at floating. Do you agree?
So whoever has comparative advantage first will borrow first.
Most will borrow first.
So you said Casey will borrow in fixed. I mean,
Rose who has advantage most of 0.9 here. So he will borrow first, meaning he will choose which one he wants to do first. He'll borrow at fixed. Because we have two options, borrow fixed or borrow floating.
yeah.
Right? So how do you know who borrows what? The person that has the most advantage in whatever position will borrow first. Meaning who will exercise his advantage first. Rose
Okay.
Bank has the most advantage in fixed, so he will borrow first, means he will borrow fixed. Then
Yes.
cash will borrow floating.
Floating. Yeah. Okay.
Makes sense?
Yes, it.
Then back to our question. One more thing to confirm. The charges, is it before? Okay, just wanted to confirm. Said Rosewood Bank has offered Keshi a swap on counterparty variable rates, blah blah, where Keshi receives 70% of any benefit accruing from undertaking the swap prior to any bank charges. We missed that part. I just want to. I remember. I just saw it. So Rosebank will charge Keshi 10% basis point on the swap. So that means what we solved here is wrong. You misled me. No, God is good. So this guy.
Okay. Bank charge is not 10 bills. Yeah, before charging bank.
Now, follow the question. It said that Rosebank will then charge Keshi 10 basis points for the swap. So net, let's make one space. Net gain to Keshi with this guy minus 0.1%. Do you agree?
Okay.
So this is net gain Keshi would enjoy. So now they said our effective borrowing rates would then be for Keshi what typing. Keshi will borrow at floating, right?
Yes.
Then
Rosebank.
he will now receive SOFR, so put SOFR in brackets from the bank. So like it to be like this. Yes. So here is net interest would be 0.4%, right?
Okay.
Then he has to pay an amount. You pay an amount, pay to bank. It is received from bank. Then he pays to bank a certain amount, which will now give him his gross interests. Then gain on swap will now be how much this guy. Then interest based on fixed will now be equal to this guy. Do you agree? Do you agree, Keshi?
5.5.
to borrow floating. So in swaps, you work back. If his borrowing is floating and the swap will make him come back to fixed, you agree that money will change hand here, right?
Okay.
So his fixed rate is 5.5%, and we are saying he will make a gain of this is after bank charge. He will make a gain of 4.6%. So that means his gross interest will be this guy minus this guy. Does it make sense?
Okay.
Then to get amount we pay to bank will be this guy minus this guy minus this guy. So he will borrow floating at 4 points at SFR plus 4%. He will receive SFR from the bank, then he will pay the bank 4.64%. So at the end, his gross interest rate is 5.04 because he's having this gain of 0.46. So our swap here is minus this guy.
Sorry, I'll be leaving the group chat now. I have something important to.
Actually, this is the end of our conversation.
Oh, okay.
Because
I just
we already agreed that we are borrowing here recommended, right? Because we recommended this guy because it has the reduced spread of 0.8.
let me send the Excel sheet.
Definitely I will send it. I will send it because this guy would only rise. This guy would only rise to, or let's let's spread this guy a bit. So let's do something like this. Oh no, okay. No, let's make it like this. Lower. No, this is floor. Floor ceiling. Yeah, so let's make everything just rates. So rather than what am I doing? So rather than bringing in number, let's just make everything rates. So the floor of option A is the least we can borrow is 4.36 and the highest we can borrow is 4.34. Do you agree? Then for option B, the least we can borrow is 4.6 and the highest we can borrow is this guy.
Okay.
Then for swaps, we just make one space.
Right.
Yes, so
No, sorry, I have something to attend. But I'll get the.
yes, you get the exam. So this guy
Thank you very much.
is equal to this guy, yes. And yeah, this is recommended because at the end we have a floor of minimum of 4.6 and maximum of 5.08. Then for the swap, it's like reading this guy again. No. So the swap now comes as high as 5.04. So swap is slightly lower than this, but we have opportunity to go as low as this guy. So this is the end of our class. We save this file. See you guys in our next class. Bye.